A moment, a moment. All right, sorry for interruption. I'm just doing a recap of where we stopped last time. We said we have two candlesticks. We have a green candle and we have a red candle. So we said a red candle will open from up. Its open is up. Then its close is down. Then we saw a green candle opening from down, closing from up. And the logic behind that was that we have buyers in the market, and these buyers want to buy at the lowest point possible and sell at the highest point possible. That's why the green candle will open from down. They are buying at a low price. They want to sell at a higher price. That's why you can see their market opening from down, closing from up. Another logic behind what I can think about is that when I buy from this point here, also Vincent buys from this point here, and we become very many traders buying from this point here. That's why this candle will gain momentum that will push it up to close at this point here. Why? Because when we buy, we all buy from this point here, down here. We have seen something, and the more we put in the money in the market, the more the demand for this particular token we are buying. And when the demand becomes high, this particular token we are buying is being demanded, then its price will be pushed up. That is another logic why the market will open from here and it will close up there. So the more we buy, the more we push the market up until it closes according to the session you are dealing with. So this candlestick also has what we call a shadow, and this is the thing that pops down and also pops up. Also pops up like this. It is called a shadow. You can call it a wick. And also this wick speaks volume about a particular trading session. When you say a trading session with a smaller wick, that means that the selling pressure or the market did not stretch down, But when you see a candlestick with a long upper wick or a downer wick, that means that for an upper wick, buyers pushed the market to the highest point possible. Then in one way or the other, sellers came in and forced the market to calm down, closing at this particular point. So that wick can mean price rejection in one way or the other. So this candle has also what we call a real body. It's body, the body of a candlestick. And also we say that this body will also tell you about this trading session. When you see a candle with a larger body, that means that the trading pressure or the pressure, or either the buying pressure or the selling pressure, was high in this particular trading session. But when you see a candlestick with a smaller body, that means that either the buying or selling pressure was very little in this particular trading session. So, also speaking of the week, before I forget, also weeks will tell you about the trading session. You can find candlesticks with long upper wick like this, and you find others with longer lower wicks like this. This means price rejection. For example, in this case, the sellers, let's first they're all ready candles. So this is the open of the market assuming, and this is the close of the market. So this trading session occurred past the open and the close, and the market was pushed up to this point here. After the market being pushed up, in one way or the other, sellers came in and fought for their rights, pushing the market down, forcing it to close. So that long wick can imply rejection, that the market was rejected in one way or the other. Then the same will apply to the longer lower wick. Sellers reject, in this case, when the candle is green, the sellers rejected and they pushed the market down. Then this one that was going down, buyers rejected and pushed it up, forcing it to close right there where it closed from. So after seeing different body sizes and different parts of a candle, we saw some chart patterns. For example, we had a candle called the engulfing bar candlestick chart pattern. I'm just doing a recap so that we can pick up from where we stopped. All right, is my voice clear? I'm seeing we can't hear you in the chat. Can you hear me now?
Yeah, we are hear you.
Okay. We continue. We saw chart patterns. In the first instance, I've been showing you parts of the candle. Then we are going to see chart patterns. Last time we talked about the engulfing bar candlestick chart pattern, and they are usually of two types. There is what we call a bullish engulfing bar candlestick chart pattern and a bearish candlestick chart pattern. In this case, for a bullish candlestick chart pattern, we are seeing sellers, for example, we are seeing the market moving down. I don't know how to use these tools. So in this case, we are seeing that I'm talking about a bullish. What is confusing me now? Let's first see what we call a bullish engulfing bar candlestick chart pattern, bullish engulfing bar candlestick chart pattern. Sellers were pushing their market down. I will use green candles, but you can understand. They were pushing their market down. Then, in the downtrend, they formed a bullish candle. So, this bullish engulfing bar candlestick chart pattern will be formed by two candles. One candle is a smaller candle, like for example, this one here. This one is a smaller candle, and another one, the second candle, is a big candle that covers everything this candle had. So we say that engulfing means shadowing. For someone standing this side here, cannot see what is happening this side, meaning that this candle here was engulfed. It was a red candle. Sellers were pushing their market down. But in one way or the others, then the buyers came in and they engulfed the sellers, meaning they swallowed the sellers. The sellers' control is now being swallowed, is now being covered. Only this candlestick will notify to you that sellers' control is over. We are now ready for the reversal. So this chart pattern always occurs in the downtrend. It always occurs in the downtrend. And when it occurs in the downtrend, we prepare for a reversal to the upside because the sellers have been engulfed. That is a bullish engulfing bar candlestick chart pattern. Let me go to my chart such that you can see it clearly. You can see it clearly. Bullish, bullish, bullish. So that is how it forms. There is a smaller body and there is a larger body. The larger body has engulfed the smaller body for the bullish engulfing bar candlestick chart pattern. You can always find this chart pattern in the downtrend. The market was being pushed down and this formed, meaning that sellers have completely lost control of the market and we are now ready for the reversal. Buyers are now ready to take over. Remember, do not trade any chart pattern you can find on the market without involving in what we call the indicators. Put in the indicators so that you can get confirmation on what is happening on the market. Then we had what we call a bearish engulfing bar candlestick chart pattern. As you can hear the word bearish, meaning we are referring to sellers. So in this case, buyers were pushing their market. They were pushing their market up. The market was moving up, making higher lows and higher highs. So after, then they formed a big bearish candle that engulfed the sellers. No, that engulfed the buyers. This big red candle engulfed this small candle here, meaning that buyers that were pushing the market up have now been completely engulfed and they have lost control of the market. They are no longer in control of the market. So the market is ready to reverse down. So this always occurs in the downtrend. No, in the uptrend. The other one, which is a bullish, occurs in the downtrend. This one occurs in an uptrend. And when you see it, just know that the market is ready to reverse to the downside. That is a bearish engulfing bar candlestick chart pattern. Then we looked at another candle called the dojis. The dojis, these are indecision candles. They are indecision candles. They represent indecision in the market. Buyers and sellers don't know what to do next. They are having equal power in this market right now. That is when a doji is formed. The opening price and the closing price is always the same. For you to easily identify the doji, the opening price and the closing price should be the same. And that will be differentiated by the highest wick or the highest price and the lowest price. The doji represents indecision. When you find it in the uptrend, we think of reversing. When you find it in the uptrend was continuing from up, no. The market was going up and it forms in the middle there. It can represent a continuation signal. When you find it in the downtrend, it is a reversal candlestick chart pattern. That is called a doji. It has like two types. There is a dragonfly doji, and a dragonfly doji is formed when a dragonfly doji is formed with a long lower tail to identify it from others. It has a long lower tail for it to be a dragonfly doji. As you can hear the word dragonfly, we are ready to fly. So you always find it near the support. When you find it near the support level, then that means the market is ready to fly to the upper side. Then there is what we call a gravestone doji. As you can hear the word gravestone. Grave. We are ready to be taken to the grave. The market is going to go down. So this gravestone doji is found in the uptrend. The dragonfly doji is found in the down trend. So I believe those who were with me last time, you are catching up because we are moving so faster. We are moving faster since I'm doing just a recap. So this is the dragonfly doji. The opening price and the closing price is the same. It is a bullish candlestick chart pattern. Then for the gravestone, it looks like that opening price and the closing price are always the same for it to be a gravestone doji. When the opening price and the closing price is not the same, then we switch to another candlestick. It is not a gravestone. Another chart pattern we looked at was the morning star. The morning star is formed by 3 candles. The first candle is a red candle that shows this market is being controlled by sellers. They are in control. Sellers are pushing the market down as they always do. Then the formation of a second candle, the second candle is small. The second candle is small, and its formation shows that don't mind about the color of the candlestick. It can either be green or it can either be red, but it should be small. And the formation of that small candle notifies to you that sellers are present, but they don't have the power. They are losing their control on the market. They are losing their momentum on the market. So the formation of a big green candle will give us the final decision of where the market is going to head next. So this morning star is a reversal candlestick chart pattern. You can always find it in the down trend. The market was being pushed down, and the formation of this morning star candlestick chart pattern will give you a clear direction of where the market is heading next. Then we have the evening star candlestick chart pattern, which is just the opposite of the morning star candlestick chart pattern. You always find it in the uptrend. The market was moving up. The first candle is a bullish candle. Buyers are still controlling this market. They are pushing it up. Then the formation of a second candle This second candle must be small in size. It can either be red or it can either be green, but it is a small candlestick that will show you that these buyers have lost their momentum. They have lost their momentum. They can no longer push the market further up. Then the formation of a third candle that is bearish. The formation of a third candle that is bearish will give us the final decision of where the market is heading. This bearish candle, the formation of this candle will give us the final decision that this market is going to go down. It is a very powerful reversal candlestick chart pattern, which is called the evening star or the morning star. So that is where we stopped last time. Before I introduce other candlestick chart pattern, you can tell me where you have not understood best so that we can elaborate more before we proceed to other chart patterns. Let me know in the chat. Are we clear? Is everything clear? We continue. Give me one in the chat if I have elaborated very well everything. So, hold on. Repeat for engulfing. All right. I said for the engulfing, we have the bullish engulfing. Where is my writing point? Bullish engulfing. For the bullish engulfing to be valid, the market was pushing down and then a small candle, a small red candle formed. The market was pushing down, meaning sellers were in control of sellers were where is my writing point? Sellers were in control of this market, pushing it down. They were pushing the market down. Then they lost the momentum somewhere and they formed this small red candle. This small red candle means that sellers have lost their momentum. They no longer have the power to push the market down at a higher speed. Since the engulfing bar is formed by two candles, then the formation of a second big candle, which is bullish, give us the final decision of to where the market is heading, or can complete the formation of a bullish engulfing bar candlestick chart pattern. Why? It's because someone standing this side is not seeing what is happening this side, is not seeing this candle. This candle is being engulfed. So that is the logic behind the engulfing bar candlestick chart pattern. Shows that sellers, they are no longer in control of the market. And when it occurs in the context of an uptrend, it means that the market is going to go down. When it go, no. This is a bullish engulfing. It always occurs in the downtrend, which means that it is a reversal to the upside. But you can find this bullish engulfing in the context of an uptrend, which means that this is a continuation signal. So, pola, so when you find it in an uptrend, it will represent a continuation signal. The market is ready to continue going up. But when you find it in the downtrend, it is a reversal signal to the upper side. Then we have the bearish engulfing, bearish engulfing. Its logic is that the buyers were pushing the market up. The buyers were pushing the market up. The formation of these smaller candles will show that these buyers have lost their momentum. They no longer have much authenticity on the market, pushing it up. Then the formation of this red candle, this big red candle, gives us the final notice that buyers have been completely wiped out of the market and sellers are ready to take up the market. So you can always find this pattern in an uptrend. The market was moving up, and the formation of this bearish engulfing bar candlestick chart pattern can change our mindset that this market that has been moving up is ready to slope down, is ready to go down. I think I'm clear, mister. And then for the morning star candlestick chart pattern, the morning star is formed by 3 candles. The morning star is always found in the downtrend. The market was moving down very well, and sellers were pushing the market down, assuming this is a red candle. Sellers are controlling this market. They have momentum on this market. Then the formation of this smaller candle here notifies to us that sellers are losing their momentum. This candle here can either be a green candle. Kiki musajja. Okay, sorry for interruption. We can continue. We are on morning star. We are repeating a morning star. We say that the market was being pushed down like this. Then the formation of this small candle here, it can either be a red candle, it can be a green candle. So it will notify to you that buyers have lost their momentum. They no longer have much power pushing the market down. Then the formation of a big green candle like this then gives us a final decision. This pattern completely is called the morning star. So when looking or when identifying the morning star, you don't look for one candle, you look for a pattern like this, and that would be called a morning star candlestick chart pattern. And it is a reversal to the upside. When you see it like this, just know that the market may reverse upward. Until you add in more technical indicators, do not trade any chart pattern you find on the market. So that is how a morning star is formed, and that is the logic behind its formation. Is that sellers were pushing the market down. In one way or the other, they lost the momentum, and the buyers took over their power, pushing the market up. All right. So those are your questions. Those are your two questions. I think I've answered your question. Repeat on morning star. So we can continue with the next candlestick chart pattern, and that is called a hammer. Hammer. A hammer. It's sometimes referred to as a penny bar, and this is its formation. It is formed like this. It is a penny bar. The opening price and the closing price are somehow the same. They are not the same, but they are somehow the same. So this penny bar will be identified by a long lower shadow or the long lower tail representing a strong buying pressure. A strong buying pressure that the market opened, assuming it may have opened red. Then sellers did a very good job of pushing this market down. After reaching this point, buyers came in. They stretched, forcing the market to close at that point there, forming a long lower tail. This shows a rejection. This shows that the price has been rejected this way. Buyers have rejected the market from going up. So you can add in some support and resistance to exactly confirm the rejection that you are seeing on the market. Just want to show you a pin bar here. So this is how the pin bar or a hammer forms. Its only characteristic is a long lower tail. Then the opening price and the closing price is more or less the same. When it is the same, it will be called a dragonfly doji. But the price is slightly the same. It should not be, the difference should not be that big. As you can go to your chart and let me go to trading view and see if I can identify a hammer or a pin bar so that I can give you a clear example. So it is a rejection candlestick, and when you see it, assuming the market was moving down, the market is ready to reverse to the upside. Let me just open my chart and see if you can identify one. We can identify the one penny bar. Let me change the coin. It's a USDT. This is Ethereum. Can we identify any penny bar here? Any candle? We have one here. That candle, you are seeing this one there. So that's how you identify penny bars on the market. The tail may not be that long. I want a perfect one. We have one here. This qualifies to be a pin bar. You can see that red candle with a long lower tail. You can see it there. So that's why you can identify the pin bars. So on the pin bar, we have what we call a shooting star. This is a bearish version of a pin bar. It's called a shooting star. And for it, its formation is formed with a long upper tail. The long upper tail. It is called a shooting star. A shooting star, it has a long upper tail. Its formation represents that buyers try to push the market up. Like you can see, buyers try to push the market up. But in one way or the other, sellers came in and pushed it down, setting pressure, pushed it down, forming the long upper tail. So this is setting pressure that is being represented here. And it is a reversal candlestick chart pattern when you see it on the market after being formed. Another chart pattern, we have what we call the harami. Harami, or you can call it an inside bar. Do you have an inside bar here? Do you have it? It is called the harami or an inside bar. Harami, you can call it a mother candle. This is the mother candle and this is a baby candle, because in Japanese, harami means a mother. Its formation represents indecision in the market. Sellers and buyers don't know what to do in this situation. And when you find this candlestick in the bottom of a downtrend, this is a bearish. When you find it in the bottom of a downtrend, it represents a reversal signal. But when you find it in the middle of either an uptrend or a downtrend, it is a continuation signal. You can join this trend right there because you have already seen a continuation signal. The market is telling you that we are going to continue going up. So that is the harami, or a bullish inside bar. Then we have what we call the tweezer tops and the tweezer bottom. Tweezer tops and the tweezer bottom. They are formed by two candles. This is the tweezer bottom. The first candle is a bearish candle with momentum. It opened with momentum like this. Then the second candle is a bullish candle. It's a bullish candle also with momentum. So their opening price and they open and closes at the same level and with the same volume for it to be a tweezer bottom. And when you see a tweezer bottom, it is a reversal candlestick chart pattern because they have formed at the bottom. Sellers are pushing the market down. Then buyers are coming in, telling them, we are present. We have the same power like you. You cannot continue pushing this market down. Then they take over to form the pattern like that one you are seeing in the picture right there. And lastly is a tweezer top. A tweezer top. It is formed when we have a bullish candle. Buyers are pushing the market up. Then sellers come in with equal volume and push the market down for it to qualify to be a tweezer top. These are all reversal candlestick chart patterns like we have seen and how they behave on the market. So you can go to your chart and start identifying candle per candle, pattern per pattern. And the more you start seeing them and you tell yourself that this is a morning star, this is a hammer, this is a shooting star, the more you become familiar with them, and the more they will help you in your trading, because most of the cases, the market respects the formation of these candles, because these candles are a visual representation of what exactly is happening on the market. Like, for example, you can see this engulfing bar. It is a bullish engulfing bar that formed near the support. What it did, it pushed the market up, like you can see. This was an engulfing bar. So these are the doji. You see those smaller candles there. They are the doji. The dojis. You can identify some patterns here. Which pattern can I identify next? This is also a bullish engulfing bar. There are very many patterns here. We can we have a doji here. We have a penny bar. We have a dragonfly. So when you start looking at these candlesticks and you start practicing what you learn, you will become more confident identifying these candlestick chart patterns. These candlestick chart patterns. In my next sharing, we shall share and see how we can, how these candlestick chart patterns can help us to predict which direction the market is going to take, after adding in some other indicators like the moving averages, the MACD, and get that factor of confluence before you enter the market. All right. I now welcome more questions. All right. Give me one in the chat if the point is home. So those are the candlestick chart patterns we have. Give me one in the chat. Give me one in the chat. All right, thank you. Thank you. And if you have a question, you can drop it. So if you don't have any question, thank you for attending. Thank you for attending. Yeah. Explorers International, you can close the meeting. Thank you. Thank you for the opportunity given to me.
Okay. Thank you for the great presentation. Guys, thanks for coming, but we are few today. I don't know what happened to others. Guys, when you keep on missing these classes and the market is promising right now, we may have an alt season sparking right now. So if the alt season finds you when you don't know what to do, I think it will be a very big mistake. You see others earning, then you'll start complaining. So guys, thanks for attending. Don't miss tomorrow's session very early in the morning. That is 8 a.m. East African time. West African time, that's Ghana, Nigeria. It is 6 a.m. Then 7 a.m. That is Southern African time. And don't miss futures trading session in the evening as well for those interested in trading futures. Okay, guys, here we come to an end of our session. Let's meet next time. You can have a great night.